Hello friends, I welcome you to the next module of IFRS. Today the target is to demystifying inventories. Inventories covered under International Accounting Standard 2. We all know that inventory is a very important aspect for all the entities, and the valuation of inventory is a major piece because the valuation of inventory impacts the gross profit of any company, and if the gross profit is not correct, then the whole financials will be not accepted by any authority. So for the big manufacturers like automobile companies, FMCG companies, even for the traders as Big Bazaar, Mall, More or Walmart, for all of these entities or industries, the profit is based on the valuation of inventory, and it's a very challenging piece. So as per agenda, if you see that, this is covered under part B, element of financial statement. Under inventories, which we will see what is the objective of inventories, the scope under IAS 2, the definitions, how we do the recognition of inventory, followed by the measurement of inventory, and at last the disclosures. Before we roll the ball, let me just, take you through certain important aspect. Like in any, the production cycle of any company or any manufacturer, for example, the automobile companies, is for 2 to 3 months. Thus, the valuation leads to even WIP inventory. And that WIP inventory is also very important to value. It's not easy to value the WIP. Accounting of inventory is also linked with the working capital requirement of any entity. Don't you think so? Because the working capital is including your raw material, your labor, your production overhead, and direct overheads related to the production. So the money is required for the same, and in any entity, considering that fact, accordingly manage their working capital requirement. So that's why the inventory valuation and the accounting of inventory become more important for any entity. Now, let's roll the ball and see what is the objective of inventory. The objective of IAS 2 is to prescribe the accounting treatment of inventory. How we account for inventory, how we take the impact of the value of inventory in our financials. So what is the primary issue in this? The primary issue in IAS 2 is the amount of cost to be recognized as an asset. And what asset we are talking about? Inventory. Inventory is our current asset. And at what value you will carry forward your asset until the related revenue are recognized. You mean, because asset is, this inventory is a current asset until unless this is sold. So till the point this is not sold, we need to reflect that as our current asset. So we need to know initially at what amount the cost need to be recognized, and also when we need to carry forward that cost until that inventory is sold. Once it is sold, then that will be covered under IFRS 15, which we have already covered. But before that, the value is very much is the value of inventory that need to be dealt under IAS 2 itself. So this is the primary issue which IAS 2 deals with. IAS 2 provides guidance on the determination of the cost, subsequent recognition as an expense, including any write down to the net realizable value, and the cost formula. Do you know what it means? It is saying that IAS 2 provide guidance at how you determine the cost of your inventory. The initial cost of your inventory, which includes your direct labor, direct material, direct variable overhead, and even the fixed overhead. Then the subsequent recognition as an expense, because if you are incurring some subsequent expenditures, then that you need to decide. You can add to the value of inventory or you need to expense off. So it has clearly given that what are the expenses which you are incurring subsequent and you need to expense off. Even if there is any write down to the net realizable value, then also that need to be taken to the profit and loss account. Because the valuation of inventory, we all know, is the value which is the cost or the net realizable value, whichever is less. In practical scenario, guys, if I take you through, in now the ERP systems are there for every entity. There they have their purchase, and the purchase is added to the ERP system. Whatever the items sold and the closing value, the system evaluate and calculate for any entity will be at the purchase price only. Now, if we compare that value which system is giving as a closing value with the market value or the realizable value, and if there is any difference, that need to be booked as impairment, or you can say that need to be booked as a write down due to the net realizable value which is coming less. So that's why this is also an important aspect, and I used to provide guidance around it. Then the cost formula. So what is the cost formula? We can have apply FIFO method, and we can apply weightage average method. So people must be feeling, why not we have the LIFO method, because that is not covered and allowed under international context. Moving to the scope of the standard. The standard applies to all inventory. All the inventory except if you have financial instrument. So that is covered in IAS 32 and IFRS 9. So what do you mean by it? If any broker or any non-banking financial institutions and all who deals in these financial instruments, or what are these financial instruments? A financial instrument is if you have investment in equities, or you have investment in debentures, convertible bonds and all. So that you need to be go for the accounting, measurement and recognition under IAS 32 and IFRS 9. Similarly, for biological asset which is related to agriculture at the point of harvest, that is covered under IAS 41, which is on agriculture. Under scope itself, if you see certain key points, it says that there may be some inventories which are within the scope of IAS 2 itself, but with respect to disclosure only, because the measurement is defined in either IAS 41 or in measurement is defined under some other standard. So for example, the producers of agriculture and the forest products agriculture produced after the harvesting has been done, even for the mineral and mineral products like coal mines, when the coals comes out of it, so they are measured at the net realizable value. They're not measured at the cost. And that's why they say that the measurement is not covered in IAS 2. For the commodity broker traders who deals in the commodity market, so for them the inventory is at the fair value less cost to sales, and that's the reason the measurement is not covered under IAS 2, because its measurement is done at the fair value less cost of sales. So we are done with the objective and the scope of IAS 2. Let's see what is the technical definition of inventory as per IAS 2. Inventory, we all know, is assets, and we also know it's a current assets. As standard says, this includes the asset which is held for the sale in the ordinary course of business. It means you are having some asset which is as good as your finished product or finished good, but you want to sell it. You have it in your stock because you want to sell it in the ordinary course of business. So this is fixed, finished good. Inventories are asset, if you come to the second point, in the process of production of such sale. So you are using some material which are in process of production, but finally you want to sell them. So this is the stage of WIP. The third point, which is inventories are asset in the form of material and supplies to be consumed in the production process or in the rendering of services. So if you are using your raw material and your supplies which you will use in production process, then this is as good as your raw material. Let's take an example of rendering of services. For rendering of services, how for any such industry or entity, what will be the inventory? For example, a car service center. A car service center, what is the main the main operation aspect for a car service center. It is like servicing of cars. In case, when they take the cars for servicing, they need to change certain spare parts, and they do some oilings and all other aspects. So what is the inventory for that car service center? So all these spare parts, oiling and all is are the part of inventory. So in the third aspect, if you see, so inventory are the asset which in the form of material and supplies to be consumed in production process for the product for the manufacturing industries. So there is raw material, and in the case of rendering of services, as I just explained you, it is is the spare parts which is considered as inventory for them. Now let's see what is the definition of net realizable value. And this net realizable value is also known as or called entity specific value. So the net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. So in general, what we know, net realizable value is the value in the market, at how much price you can realize your inventory in the market. Because inventory valuation, you will see, is always on the value which is cost or net realizable value, whichever is less. So it's very important that we need to calculate the net realizable value at the reporting period. In practical scenario, if you see, for example, in September, you did some purchase of, for example, take an example of $100. And in December, the same, the inventory is still in your stock. And when you did the market, realizable value, when you try to find out, so this is the value at which you are right now selling those products. So for example, that 100 rupee cost which was in September for your that inventory, now you're able to sell in the market only at the rate of 95. So it means that there is a deterioration in the value, and that's why you need to book your I should say that your net realizable value is less, so you need to reduce the value of your inventory. So this is very important, that you need to know how practically you evaluate the net realizable value or entity specific value. Net realizable value is the current sale value of your inventory. Or if that is not possible to evaluate, in some of the industry that could be the case, then you evaluate on the basis of your future cash flows. So what you are expecting by selling that inventory in the market, and how much future cash flow you will get from it. And that's why that will become entity specific value. Coming to the next definition, which is fair value, and it's important to know what is the difference between net realizable value and the fair value. So net realizable value is, as I just told you, is the value which actually you are realizing from the market over the entity specific value. On the other hand, the fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant at the measurement date. So this definition of fair value is covered from the perspective of both as an asset or a liability. And this definition says that fair value is that price which someone can receive when the entity sell the assets, or when they are transferring a liability, what they need to pay. And this transaction should be an orderly transaction between market participants. So there should be the parties involved into it. At the measurement date, so date on which they are actually measuring that value. So this definition has been derived from an IFRS 13, which is fair value measurement. Because the whole IFRS is based on doing the fair value measurement. They want it to be the items at the real value, and that's why they have defined this fair value in IFRS 13. There are certain important keynotes related to the definitions which we have covered. Inventory encompasses merchandise, land and building for resale, raw material, WIP and finished goods. So I have already explained you that inventory includes all this. It includes your merchandise, consumables, raw material, WIP, finished goods, and even if you have land and building for the sale or resale purposes for real estate industry. So for them, the 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 manufacturer or the land, if they have intention to sell it to the customers, or if they have the ready-made flats or the plots, then that is inventory for those real estate industries. The cost which you incur to fulfill a contract with a customer that do not give rise to inventory or asset within the scope of any other standard are accounted for in accordance with IFRS 15, which is revenue from contract with customers. You know what? Here it says that if you are incurring certain cost, no, to fulfill a contract with customer. A customer, for example, turns up to you. You are a furniture manufacturing industry or entity, and they want that when you uh, prepare, when you work on those furnitures for the customer, they want their logo on those chairs or whatever the furniture order they are giving to you. It means you are customizing your output as per the requirement of the customer. So in this particular case, you need to account for that value which you are charging against the customized service to the customer in IFRS 15. So what IFRS 15 talks about it? It says the treatment. So what is the treatment? You recognize an asset only from the cost incurred, from the cost which you incur to fulfill a contract. Coming to the measurement. So we're done with the key definition. So how we measure the inventory? We measure the inventory at lower of cost or net realizable value. And this cost includes all the cost which you incur to bring the inventory with a condition or to the present location or the condition wherein the entity has intention to sell it. We will further elaborate that what are the components of cost. But to begin with, it's important to note down that this cost includes all the costs which an entity will incur to bring that inventory to the present location and in the condition of sale. So what are the component of cost? Component of cost is your purchase cost, your cost of conversion, and your other cost. So now you would like to know that what should be included in purchase cost, how to understand the cost of conversion and other cost. So let's see this very important slide. The component of cost, as we have just known, is purchase cost, conversion cost, and other cost. So this purchase cost includes your actual purchase price. It also includes if you have paid some import duties and taxes. However, if there is a semittable tax or refundable tax, then that will not be part of purchase cost because you're gonna get either the benefit of it or you get the refund of that tax. So this should be the taxes which is non-refundable. Any transport and handling cost and need to be added to the cost of inventory. However, exclude any trade discounts and rebates. If you have received any trade discounts and rebates, then that should not be added to the cost. Conversion cost includes when you do the production and direct labor, because the material cost, the direct material cost has been included in the purchase cost. So conversion cost, when you apply your labor and the direct labor is converting your raw material into WIP and then finished good. So direct labor cost is the cost of conversion. Similarly, you have fixed overhead and the variable overhead is also your conversion cost. What include in other cost? So other cost, as it just defined, that the cost to bring the inventory to the present location and condition. So one of the example of other cost is borrowing cost, and we have covered already borrowing cost under IS 23, wherein we say that if you are have taken a loan and you have an inventory which is very specific, for example, like in case of aircraft industries, in case of big truck manufacturers and all, if they have taken loan for the manufacturing of those aircrafts, ships and trucks, then they can apply the borrowing cost or the interest cost and can capitalize to the cost of inventory. and that's why borrowing cost is part of other cost. Now how we do the allocation of this cost? So the allocation depends upon the cost type. If we have the fixed production overhead and the variable overhead. So the fixed production overhead allocation to the cost of conversion is based on the normal capacity of the production facility. However, the variable production overhead is allocated to each unit of production on the basis of actual use of the production facility. So we all know the fixed production overhead is allocated on the normal capacity of the production. However, the variable is the actual. So variable cost vary with the actual production. Now build some more understanding around dealing with the fixed cost. The keynote says the low production cost or idle capacity will not result in a higher fixed cost to each unit. So let's take an example. For example, you have a fixed cost of $100,000 and your normal capacity is 10,000 units. So for this 10,000 units, what is your per unit fixed cost? So per unit fixed cost is $10. Now there could be three conditions. If you are able to produce this normal capacity of 10,000 units, then your fixed cost per unit is again $10. However, if you have produced low or your plant was idle for some time because of certain reasons, and you're able to produce only 8,000 units as compared to the 10,000 unit which is the normal capacity of your plant. Now in this case, how much cost or fixed cost you will charge? It says the standard has clearly mentioned that the low production and the idle capacity will not result in the higher fixed overhead to the each unit. You will charge only 8,000 unit and $10 per unit is $80,000 is your cost which you charge as a fixed cost, and balance $20,000 will be charged to your profit and